This unit is called weighted average cost of capital. We've been dealing with this concept throughout the semester when we've used terms like the discount rate or cost of capital. Weighted average cost of capital represents the average cost of financing projects for the firm. So our goals here are understand the concept of cost of capital, understand the components, and do a simple example where we calculate the weighted average cost of capital. Weighted average cost of capital represents the average cost of financing for a firm. So think about this for a minute. When a firm raises money or capital for its projects, it raises it usually from stockholders and debt holders. The debt could be a bank or it could be a bond. But the point is, or maybe we'll have some preferred stock, but the point is we have multiple investors who provide us financing. Each of these investor types wants a return on their investment. So the idea is that weighted average cost of capital looks at the returns that each of our investors wants and how much money they're contributing, and it takes a weighted average of that return. So this is the cost of financing projects for the firm. So for a project to be desirable, it needs to return enough money or a high enough percentage to exceed the cost of financing. When we do weighted average cost of capital, we use market values. So essentially we're saying for every dollar we raise going forward, what portion will come from debt, what portion will come from preferred stock, and what portion will come from common equity. We use market values because it reflects the current condition of the firm. We avoid book values where possible because remember, those are historical numbers. Here's our formula. Here I've simplified this and we're ignoring preferred stock for the moment, but we have equity and debt components to our weighted average cost of capital. So if you look, we have RE, which is the return on equity, think CAPM. Then we have RD, which is our return on debt. So this is the return required by debt holders to invest in our firm. And our terms there with E over E plus D and D over D plus E give us our weights. So it's the relative proportion of our total firm value that debt or equity compose. Notice that we take the cost of debt net of taxes. We do this because when I pay interest on debt, I can write it off as an expense. So it reduces my taxes. So we're looking at the net cost of debt here. So hit pause and read through this paragraph. It sort of summarizes what I've said over the last few moments. So let's look at a quick example. So consider a firm whose debt has a market value of $40 million, whose stock has a market value of $60 million. So in other words, the firm is worth $100 million if we add those two parts together. 40% of that's debt, right? $40 million out of 100. 60 million of that is equity, or 60%. We are assuming that going forward, the firm's going to raise money in that same proportion. Okay, so out of every dollar they raise, 40 cents would come from debt, 60 cents would come from equity. If you look at the rest of this problem, it tells us the rate that we'd have to pay on new debt, that's the coupon rate, and the beta of the firm. So it looks like it gives us some CAPM information so that we can solve the cost of equity. So let's go through this example. First, just to summarize how I got the weights, there's 60 million in equity out of 100 million in value, so that's 60%. Debt, there's 40 million divided by 100 million in value, or 40%. So we would say, in general terms, the firm's capital structure is 60% equity and 40% debt. Our cost of debt is 15%. So if a firm were to issue a brand new bond for this project, they would pay a coupon of 15% because that's the return that investors want to hold the debt. For the cost of equity, we apply the CAPM equation, which is the risk-free rate plus beta times the market portfolio risk premium. So here the problem says we have a 4% risk-free rate, a beta of 1.41, and a market portfolio risk premium of 9.5%. If you put all this together, you get a cost of equity of 17.4%. So let's summarize what we have. 40% of our money comes from debt. Those investors want a 15% return on any new debt that we issue. 60% of our financing comes from common equity. Based on CAPM, these investors want 17.4%. So when we put this all together, we get the weighted average cost of capital of 14.4%. So what does this mean? Well, this is our hurdle rate. This is the return our investors want. So for me to pursue this project, we must at least generate a 14.4% return on every dollar we invest. So what I could do here is calculate the IRR for any potential project, and we would only invest if the IRR is greater than 14.4%. Now, we're about to go to additional lectures on this, but keep in mind, the WACC is only applicable in this form if the project is similar to what the firm normally does. Remember, beta measures risk. If this is something new or different, we may need to rethink the beta. So that's weighted average cost of capital. Let's go to the next lecture.